Okay, welcome out to our Coaches Show on a Tuesday afternoon, 3 p.m. Eastern Time. We've got Matt Justice, Noah Davidson, and myself, Tim Justice, here to host the show today and to talk. We're also double dipping and we're recording the audio for our Trading Justice podcast. Matt, how are you doing today?
Doing fantastic, brother.
Good, good. Can you guys see my screen on the video side?
Perfect.
Now, what we're going to do today, guys, we've got a list of some of our pro members and our team members from TackleTrading.com. We're going to go through some of the charts that Noah was talking about over on the Clubhouse. We're going to talk market conditions. We're going to take questions, about strategies and the whole thing. We're going to spend probably about an hour or so. That's what I planned on for our Coaches Show. Noah, why don't you say hello to everybody?
Hello to everybody.
Yeah. Let's start with the market itself. Interesting volatility right now. And I'm going to bring up a page here. We're going to go to FinViz. Markets are down another % today, Matt. What's happening out there?
Honestly, global markets are reacting. It's not just here in the U.S. It's in Japan. It's in the Asian markets. It's in Hong Kong. It's in Shanghai. It's in Australia. It's in London. It's in the ECB. You name it. We're dealing with. We've been talking about this for 2 years now, guys. It's coming, and we're starting to see the face of it right now. Europe is in a recession right now. Japan in a recession, admitted. I mean, the BOJ came out today and admitted they're in a recession. The U.S. marketplace is starting to reflect that, and things are starting to turn over. And it's nothing I'm seeing today is surprising in any capacity to me.
Well, it just made me think of an article that I linked into one of our Facebook pages at Tackle Trading about the global upcoming recession. And there were a few different pictures I put in here I want to show you. One of them, and by the way, guys, if you have Facebook accounts, find us on there, Tackle Trading on Facebook. We put images and articles and comments in there all the time. We're trying to do the social media thing with our site as well in our team. So that's another way to hit us up. Let me see if I can find this. But anyway, it was the International Monetary Fund, Matt, and they were saying there's about a 30% chance they believe that the Eurozone, that's what they call it, is going to go back into another recession. Here it is. It's the article right here.
The IMF is, think about the IMF like a central bank, always being positive. 30% is I would actually put it in the 70-80% probability range. I think they're low. I think we're already seeing recessions across the globe, and I think we're just starting to see the face of it.
Yeah. Noah, for you, when you hear international news, like there's something going on in Europe or the Bank of Japan, I mean, how does that impact your day as a trader here who trades options and stock in the United States?
Primarily what I do is I watch how the U.S. futures trade overnight in response to the news. And you can one of the things I look for is I look to see what's going on. With the Nikkei, I'll watch the DAX, and I will watch the U.S. futures as that news unrolls. So the first thing I do in the morning, well, actually the first thing I do before I go to bed is check the futures and check the headlines. Then the first thing I do when I wake up is check the futures and see how they responded. Check the headlines and look for any signs to which way we're going to open. I thought going in today's open was pretty obvious bearish signals. That's why I put up on the blog a bunch of bear picks.
Yeah, I did see those.
Scans for and found last night just some candidates that would be worthy of watching for a downward market day.
Well, and that's just a reminder to me, guys, to check the Clubhouse in the morning to see what people are doing. Noah was in there this morning and putting in stuff about some bear picks for the day. We're going to go through some of those. But why don't we step back on that for a second, and we'll go through some of these charts. I'm loading into Thinkorswim right now so that we can look at the futures stuff. I want you to show us a few of the charts that you look at pre-market. But I want to start with this Trade Center tab. How would somebody use this world map right here?
It's one, to understand when the markets are open and when they overlap is really what I look for, so that I understand what's going on with the marketplace. There's key hours, and I have to reference it to my time zone. So I'll log in, I'll look at that map, and I'll just figure out, okay, well, it's this time there. Those banks are open. That's what's moving. And around 1 in the morning my time, I'll see an overlap between Asian and European markets. And then early in the morning U.S. time, you have trade desks open prior to the U.S. open. So I just get a good feel for which way the markets are moving, and pay attention to which way the dollar is moving. Pay attention to which way the S&P futures are moving. Pay attention to which way I'm seeing the global markets move. I'll check the NKD and the DAX, and then I'll just look at the S&P is the primary one I look at, but I'll occasionally look over at the NASDAQ and the Dow to see if they're moving in kind.
Right, right. I was just thinking here, Matt, we're doing podcast and coaches show at the same time, which I love, but we've got to remember the people on the podcast can't see the video. If they did want to go find that video, where could they get it?
Well, just go to tackletrading.com, sign up to become a pro member, and get everything that comes along with it. I do want to talk about kind of why it's important to understand which markets are open. Sometimes there's two reasons why I feel like understanding what markets are open is important for us. Number one, if you're a currency trader. If you're a currency trader, when a market is open, the currency reflective of that marketplace typically will be in some type of trending condition against the U.S. dollar. And so when the Japanese market is open, typically the yen will move a lot more against the dollar and against their cross pairs than when the Japanese market is closed. Same thing with the Eurozone, same thing with London, same thing with Australia, same thing with New Zealand. So when other markets are open, their currencies behave in a trending environment, unlike when those markets are closed. So that's number one. And number two is you can really get an indication of what the U.S. market is going to be doing or what the other markets are going to be doing based on the news cycle. When you have, for example, when you have the IMF come out today and they say, that they're cautious about a recession. They actually lowered the GDP growth of the U.S. They lowered the GDP growth of China. They lowered the GDP growth of the Eurozone, and so they came out that today. But when they made that news, the Asian markets were open. And if you'll go back to that map real quick, T. If you'll look at kind of the major marketplaces, it says that Shanghai was actually up 0.26 today. Hong Kong was up 0.46 today. If you look at that, that IMF news is not built into that marketplace yet. Because when that news came out, those markets were closed. And so more than likely, those markets will open up down. And again, it's not a guarantee, but more than likely those markets will open up down because it's following the news cycle. Sometimes we get news that comes out of China or Shanghai or Tokyo or Australia or something late at night when the U.S. markets is closed, and that will be priced into the U.S. market. And so, understanding what markets are open, from a currency standpoint, understanding the news cycle, it can really help us understand kind of where the market's going to be going.
Now, you had mentioned the dollar-yen cross pair, and that is one of the most traded cross pairs, in the foreign exchange market, probably one of the most traded products in the world.
I think it's like number 3 right now.
What is it about this pair that makes it so important?
Well, number one, importing, exporting, you're talking about two economic giants out there, Japan and America. You also got, the Eurozone, you got London, you got China as well, but you're talking about two economic giants, number one, but you're also talking about you're talking about 2 of the 6 currencies that are actually a reserve currency. You have the U.S. dollar, you have the euro, you have the British pound, you have the Japanese yen, you have the Australian dollar, and you have the Swiss franc that are actually reserve currencies out there, and no, the Chinese yuan is not one of them. So you're talking about one of the major currencies out there, you're talking about one of the major economies out there, and you're talking about 2 currencies that have been widely been stated to be in a quote-unquote currency war, where both currencies have been trying their damnedest, so to speak, to try to devalue their currency. And the Bank of Japan, and along with their central bank leaders, their political leaders, over the course of the last year and a half, they really have tried publicly, come out publicly and stated that the way they're going to fix their economy is by devaluing the yen to encourage more exporting than importing. Well, that's what we're trying to do here in the U.S. as well. And so you kind of got a little bit of a race to the bottom between some of these currencies out there. And so it's a widely popular currency to be trading, and the dollar against the yen has just been exploding. I do think it's a little overvalued right now. I do fully anticipate the yen the dollar to devalue short term against the yen, coming back down in price.
Noah, as a technician, tell me what you see in this chart right here.
Double top, some bearish cycles up there at the top. So the first thing I see is slowing momentum. As the prices rise, you see the general slowdown. And then I see a double top. M for murder, we see a potential break of support. So pretty clean and easy signs. Your oscillators will diverge. You will get signals from like your MACD if you look down.
Yeah.
Well,
I didn't even see the MACD, but I know it's going to be confirming down.
Right here.
Yeah, no. If you remember, we were talking about this last week about a potential very aggressive trade about short dollar right now and long commodities.
You know, you guys
Absolutely.
are attending the coaches show, and you're listening to Noah and Matt and myself, Tim Justice, all the coaches at Tackle Trading. I think Gino was going to pop in if he could, right? I think he was doing a bunch of stuff today, but we'll see if we can get him on here a little bit later. You know, let's test something out real quick, because I'm still new to this go-to meeting. We've got 8 attendees here. Somebody try to put something in the chat. Noah, eventually we're going to figure this chat thing out. Or use the question and answer section. I think if you type in there, there's a hi from, there you go. Hey, coaches. Okay, so if you do have questions come in, you can put them in that question section, and I'll be able to see them come through.
Where's the question section? I'm still finding it.
I don't know. Mine is down. Mine's right here. Is this up in front of your screen?
No, I can't see it.
Anyway, yeah. So Bo put in Go Braves. Owen put in Hey Coaches. Harvey put in Hi. Are the I don't even follow the Major League Baseball playoffs right now. Is that any good, Matt?
I think, Tim, we can actually enable their microphone right. So I'm assuming most people are watching on some sort of laptop or tablet, and we can uncheck their microphone. So if they want to actually ask a question, they don't have to speed type it out. They can actually
That'd be
ask
cool.
the mic, and we can enable their microphone rights, and they can just ask their question.
Yeah, why don't we do that? And in maybe about the last 10 minutes of class, we'll open it up for Q&A. Or anytime. I guess I'm pretty free and loose with the way we run these things.
I heard that about you, Tim. Is that wait? Was that a secret? I'm sorry, I didn't know.
Oh no, I'm gonna leave that one alone because it's too.
Well, you wouldn't have that reputation.
Let's get back to trading, guys.
I got it. I'm sorry, I can't stop.
Well, I'll tell you, Matt, you know, one thing about the dollar yen that I find really fascinating, the reason I wanted to talk about the technicals for a minute, is that Forex is traditionally said to be a very technically driven market. But there's a lot of news that impacts it as well. As you've traded Forex over the years, have you seen it to be more technically driven than, say, stocks or options, or less?
Number one, I think the Forex is the truest market. I think it's more technically sound than other markets. And think about it like this. When you're dealing with the U.S. equities market, for example, you're dealing with a total, including the bond market, stock market, options market, the entire marketplace. You're dealing with about a $600 billion industry every single day. And in that $600 billion, you have massive high-frequency traders, like Citadel, and you have massive hedge funds like BlackRock that control billions and billions and billions, and up to trillions of dollars. And so they can manipulate that market a little easier than you can the currency market, which is a $4 to $5 trillion daily industry. And so every market is a news-driven market, especially right now. But at the same time, you really can find the currency market to be a little more true market in terms of just supply and demand justifying price action.
Hmm. You know, we had the dollar yen up there just a minute ago. I just brought up the euro US dollar. It's no coincidence that the one was in an uptrend, the other in a downtrend, and you'll notice
Well,
that
well, they're
it's
both the
based.
same. I
Yeah.
mean, they're both the same because the currency pair to reach USD slash US dollar, excuse me, USD slash Japanese yen, and then on this one it's euro slash US dollar. So both currencies, the euro and the yen, are devaluing against the dollar recently. But I anticipate both of those to actually correct.
Yeah, and the reason I brought these two up, Matt, is maybe to bring up a conversation of something that might be real basic to us, but for a beginner out there who's never traded currency, what's the difference between the base and quote currency?
Well, currencies are listed a little different than stocks are. Stocks are listed in individual symbol. Currencies are, it's like you travel to a foreign country and you take your currency, you exchange it for another one. Currencies are listed in a pair. And so when you deal with a pair, you're dealing with two actual currencies. So in this one, the euro is traded against the dollar. So the first currency listed is the base currency. The second currency listed is the counter or the quote currency. So in the currency pair, we have two currencies listed. The base currency is two things. Number one, it's what is reflected on the chart. So on the left-hand side, you have the euro being the base currency. It is going down, which means the euro is devaluing against the dollar. On the right-hand side, you have the US dollar versus the Japanese yen, and that is going up in price, which means the dollar is going up in relationship to the yen. So that's number one. And also our transaction. The transactions we make in the currency market are always done on the base currency. So if we wanted to buy the yen, for example, we would first sell the dollar. If we wanted to buy the dollar on the euro dollar, we would first sell the euro. So our transaction is done on the base currency, which is the first currency listed, and the chart reflects the base currency as well.
You know, I'm loving
Can I add to
seeing.
that?
Yeah, absolutely. No, go right ahead.
The quote price is how many of hours it takes to get one of theirs.
Yes.
Yes, that's the simple way of stating it. That's like when you go over and you see the kiosk and they give you the quote price and you look at that, and I want to exchange my dollars for euros. It's going to take me $1.2678 to get €1. And so that's your purchasing power in compared. And if you go over to Japan, well, that's how many yen it takes to get $1. Whichever is listed first in those symbols, as Matt said, is the base currency. The one that is the second is the one that they're quoting, and that's how many of those it takes to get the base.
Which
Well, and if you pull up the dollar yen real quick,
okay,
and put it on like a weekly chart, if you don't mind.
do that. And at some point, I want to look at the futures contract for the DX, that index for the dollar. Talk about that a little bit too. So here's a weekly on the dollar yen.
There's a weekly chart, and if you look back to 2012, 2013, the dollar in relationship to the yen was very cheap. The dollar was like 75 cents, 80 cents, 85 cents, in that range. And that's when the Japanese came out. And what that means is our money, their money buys our products a lot cheaper. And so we do a lot of exporting over to Japan when our currency is underneath their currency in terms of a 1-to-1 ratio. And so what the Japanese did in 2012, it's a economic policy called Abenomics based on the individual who is the premier over there. Basically what that is it is the Bank of Japan putting money into their markets and printing as much money as possible to value the yen against the dollar so that they can encourage basically economic progress and whatnot. And quite frankly, it's been disastrous for the Japanese marketplace. The Japanese market is going to go into yet another triple-dip recession, and it's sad what's happening, but at the same time, it was done on purpose.
You know, I'm going to hit this out on Twitter, Matt. Yeah, I really believe in all the social media outlets because it's a way for us to stay connected.
Yeah, I've been trying to get Daniel Tosh to retweet me for an hour.
Dan Tosh, huh?
Yeah, it's not working out so far.
Oh, that show he has is gone for like 10 years, it seems.
It's funny.
Whatever. No, one thing Noah was bringing up earlier that I found really interesting, kind of sparked this whole conversation, is that he was looking at the markets. He woke up early, you know, saw the market about to open. He then saw a bunch of bear triggers, and we're going to go look at those bear stocks in the clubhouse just in a minute. But Noah, we've been talking about these currency pairs. What about the index? I mean, or the futures contract? What's the advantage of watching, say, the U.S. dollar index instead of one of the specific pairs?
It gives me just it's an amalgamation of all the pairs. I believe the quote is against 5 or 6 major currency pairs, and it just gives me an overall strength of the dollar. It's one I would use to correlate overall health. It's one thing when you look at the currency market and you kind of look at the general behavioral patterns of the central banks. They've all been diluting their currencies. They've all been in quantitative easing modes. So then it becomes a question of, which currency is more valuable. And when you compare one currency, the U.S. dollar to the Japanese yen, that doesn't necessarily give you a true strength of the dollar. If the dollar is weak and the yen's just weaker, I don't know. I think it's almost like college football. Like they have some of those smaller time teams trying to go up against the big time teams. It's really hard to tell you how good they are when you can only compare against one team. That's why they have to play it out over the season. So it's the same kind of idea. Comparing the dollar against the other major currencies, all 5 of them at the same time, gives me an overall picture of the strength of the dollar.
Yeah, and I'm gonna ask both of you guys this rapid fire. What are the 2 most important things you look at pre-market? Because I think this would be one of them up there. What's another one? Let's start with you, Matt.
The futures contract on ES.
So the ES contract. And when you break it back down to,
the dollar index and the E-mini contract. And by the way, interesting note here, the marketplace rallied spectacularly last Thursday and Friday, and yet it's almost ready to give up all of its gains.
Yeah, no, we're looking at that right now. I mean, it hit the low at 1918, sparked a rally into the afternoon, carried through to Friday. Friday was a huge day on that jobs number. We had that bonus coaches show that we did, which I thought was really neat that we all jumped on and did that.
Remember what I said about that jobs report? It was a joke of a response in the market.
Right. And then selling Monday, and then pre-market. Let's look at this right here real quick. And you're seeing, even as we're talking here, guys, I mean, there's some action going on. Market broke down intraday here. Noah, you called this early this morning, and you were seeing some weakness early. What were you looking at here exactly?
I saw it just from yesterday's time frame. Just go back to that daily time frame. Look at it from the bigger picture. And what I saw on that chart was the Friday rally gave way to that bear signal candle at the support zone. So I just saw that candlestick yesterday. I'm like, yeah, we're going down. So today was an easy call to shot, easy shot to call. I didn't say that right, but hey, easy shot to call when you have a really good signal candle like that on pretty decent volume. And if you compare the up candle from Friday to Thursday to Monday's candle, where you see a little bit higher volume and selling pressure. So it was a bearish retracement type pattern overall. And what I did is I ran out and ran scans for the similar pattern. I found a handful of stocks with like patterns. So if you're not going to take advantage of just the index in and of itself or trading the futures, you can find stock candidates and find potential trades, different types of trades. You could do, intraday stock trade. You could do, options trade. You could do credit spreads and things around it. A lot of different opportunities. The ability to find them, I think, is the key. See it coming and finding them.
Yeah.
And just being ready for the day. I wanted to put that list out just to give all of our tackle trading team members stuff to look at.
Let's bring.
By the way, 3,000 contracts were just bought on the dollar index.
Bought?
Yeah. That's high frequency.
Yeah. Yeah, those algos are no small deal these days. Unbelievable.
Into the close.
Yeah. Let's get into some of these picks that Noah had in just a second, but I do want to just add to what we were talking about and kind of sum up some of this, guys. In the morning and also throughout the day, looking at some of the major indexes or futures contracts on the dollar, the S&P E-mini, you could even look at the Russell or the Dow or the NASDAQ, but one of the just stock market charts. But also I'm going to throw in gold, Matt. This is the gold contract right here. Well, this one's dollar, but GC/GC. And you can find all of these symbols, by the way, guys. If you're a Thinkorswim user, just go into this drop-down menu, find the Futures tab, and almost everything will be listed in there. So if you don't know exactly what some of the letters are for one of the indexes, then just go into that menu and you can locate them. Let's take a look at some of these picks. Noah, I'm going to go back to Tackle Trading. That clubhouse is rocking lately.
Some of the picks were ready to pick off. Some of them were not set up yet. They were just getting there.
Well, I also want to spend some time on the weekend newsletter and also discuss a few of the scouting report picks as well. But let's start with this clubhouse and look at a few of those from this morning. Let's have you choose one or two from your list that you are more interested in. You had Shield, T-Row, quite a few here.
Dollar General I thought was pretty, and I thought that Sears was not quite set up yet. The XLY was there, and I think it gapped. Exxon Mobil is not one that moves real big. TPH was a pretty setup, so they all had pretty good setups, and I ran scans and found the candidates and just quickly perused through them, and they all had pretty decent technical setups. Start out with Dollar General.
I'm going to load up Mock Trader right now, and I like the charts over at Mock Trader. They're pretty clean, especially for a video call like this. So DG is the symbol on Dollar General. Matt, let's have you first analyze this one technically.
Slowing momentum to the top side, filling the gap price, coming into resistance at 63, confirm back down. It's a pretty standard setup.
Pretty easy call with the bearish. We'll call that a dark cloud cover candlestick.
Yeah, it is dark cloud and kind of movement to the downside. Yeah, definitely Dollar General going down.
You know, this is a simple concept, but I think an important one to kind of highlight. Traders tend to look at levels when they're trading. And even though it wasn't part of the exact candlestick here, the fact that this old support was playing in here, Noah, probably played a role in your analysis, I'm guessing.
Yes.
Yeah. So why do price levels like that, just from a psychological standpoint, why do they mean anything in the market?
I think they're self-reference points for people kind of looking at what they have bought the stock for, what they are hoping will hold. If you look at when the little $63 support zone broke, there's a little bit of a oh shoot factor where if the support zone breaks, people who bought at that price are going to dump it. You'll see some of the bears kind of get excited and they'll jump in and start selling it short. You'll typically see a spike in volume when support and resistance zones break. And I don't know that for sure. I'm just making assumptions on that, and I haven't taken a real close look at it. But look, right as it broke support back in mid-September, look at the volume activity pick up. So right as that support zone breaks, picks up, then it calms down, and then as it rallied, you'll see that the rally kind of died off. The volume on the rally was a little weaker, and so it's just I also like the gap. You know, this particular price level. People look at those price points. I think they become part of their decision-making process. I think every trader has read the book about support and resistance, and so those are the price points they focus on, and they become action points for us.
Something interesting came up with this chart I want to highlight, and this is a very common mistake I see new traders make, is they wouldn't have picked out that this volume was a big deal here because in comparison to this bar, it doesn't look like much, right? But this bar probably was what day, Matt? I'm guessing earnings?
It was earnings.
Yeah. So when you're looking at volume spikes, you have to like put the earnings spikes in a basket of themselves. You look at them independently and different than almost everything else. Dollar General is an interesting one. I like it. Let's pull Sears Holding. It's one of my old favorites that I used to trade quite often.
And those are in essence kind of a similar trade because they're both retailers. They're both going to be, and this one is not sent off yet. This one's ready for the picking. I said some would be ready to hit, some were not. This one needs a signal. And what I do with these types of setups is I'll take that general support resistance zone and the big bearish break. You just see that big break below the 32.50 price. It just drops to 25. You get bears buying to cover. You get some discount shoppers in there. And pop open the volume, Tim, and I'm just guessing that you'll see a good amount of volume on the breakdown and the volume waning as it rises up.
Oh, wow, that's a good look right there.
Now, I'm going to be completely honest with you. I didn't even look at the volume. That I glanced at it for like 2 seconds, maybe. These I threw out, and I put that list together in moments last night.
Yeah.
And that's what you get when you look at enough charts. You know what you know what you like when you see it, and that's a telltale sign that you have a lot of inventory coming into the market, and that rally is very suspect.
Matt, touch on
So,
this one for a minute. Why does volume spike on breakdowns like that, and what does it mean for the
Everybody
chart?
sells. I mean, technical systems are fairly consistent in the marketplace, and when you get a breakdown out of a support level that's a fairly important support level at 32.5, it's going to trigger a lot of sales. I mean, and not just short orders, guys. I mean, think about how we teach people to play stop losses. You know, if somebody's long stock on Sears Holding, you know, not that you would be because it was in a downtrend, but I'm saying just in case, we teach people to place a stop loss underneath a support level. And so when you have a support level get broken, it's going to trigger short orders from traders. It's going to trigger, you know, people to get out of the market because their stop loss is being triggered. That's what creates a lot of the increase in volume. And so you get a big drop down in price because you got a lot of selling activity. And like Noah says, down at the bottom price, you know, people are going to buy at a discount. You're going to have shorts that are buying to cover, which is going to be less volume, and it's going to drive it back up into resistance before the traders hit it again.
well, I like what you said there, Matt, about the trading systems are going to be consistent. What we describe after the fact is kind of the emotional response to the trade, the human response.
Mm-hmm.
A lot of that volume is technical based off of the trading systems, the automated trading systems.
Well, and that's the thing that a lot of people have to understand is that a great majority of the marketplace on a daily basis is not people. It's not people making
Did you
trades.
see that deal I posted on the blog about the trading floor being a big facade, the New York Stock Exchange trading floor?
Yeah,
It's just a big facade. And like, you know, that's not like we didn't know that,
No,
but
did you hear that
it's
Mark
just funny for.
not even post pictures of the trading floor any longer because there's nobody on it? I mean,
Well, I don't know what NBC interviews down here on the trading floor, and there's like some guy walks in the background.
I think it's just,
I don't know what's going on there, but
you know, they're planting people. But I'm dead serious about this, guys. High frequency traders, you have to, if you're going to be active in the marketplace long term, you have to understand what they're based on. You have to understand what they do. Because the old fundamental valuation of companies, that's not the marketplace in 2014. The marketplace in 2014 is a federal central bank interest rate dominated, high frequency trading dominated marketplace. And whether you like it or not, it's going to get worse, not better.
well, and the trading algorithm. I've been trading long enough. I started trading back in '97 on dial-up internet. And I can tell you that the things that I was taught and that I learned about the psychological and emotional reactions of traders, the markets behave the same, but they move faster because of the automated trading system. So what happens is the programs and algorithms are written based off of the trading models,
Yeah,
and
exactly.
it just speeds up the process. So the old idea of support breaking and then prices rallying and the human component that we described. Like when I say support breaks, that's oftentimes what I'll refer to as the oh shoot, or you could probably use a stronger word if you want. Traders will dump it because the support that they were banking on broke. The bears will be like, oh yeah, giddy up. They smell blood, they smell fear, and they're opportunistic feeders. They'll come in and they'll jump on it. But the reality of it is it's happening so fast. It's primarily the automated trading systems trading off of those old models.
And honestly, if you look at the macro perspective, when you're looking at the overall S&P 500, you're seeing a marketplace that is very similar technically than the ones that were dominant in the 1990s.
Yeah,
absolutely. If you compare the S&P 500 from 1995 till 2000, and then you compare it against say 2009 to 2014, you got a very similar time frame. Technically, they're very similar. But the difference is the S&P 500 has actually went up about 25% more in this bubble than it did in the dot-com bubble, and it's because of the high frequency trades.
Pop open a chart of the spider on a monthly time frame. Go spider monthly, SPY monthly. You have to do the spider so you get the volume.
Oh, get the volume. Yeah.
Yeah, and show the volume from the time. It's ridiculous how much more volume there is.
How much more volume there is even today versus say the 1990s and the 2000s.
Now, I do think it's probably some of this frequency trading, obviously it is, but don't you think some of it might be a transition away from mutual funds a little bit too, towards ETF-based investing?
Well, I can tell you a real quick story. I had a next door neighbor he owned the largest brokerage firm in Salt Lake City, and one day I was talking to him over the fence, and he asked me what I did for a living, and I told him what I did. He's like, "You guys ruined the stock market." He got real grumpy with me because it really changed hands from the broker to the individual trader. And access to the internet, the distribution of information, and access to discount brokerage firms put the power in the hands of the people.
Well, guys, I honestly think that's overstated. I don't think a higher percentage today is trading their own accounts.
It's attributing to. It's still overall. I think the overall volume.
A 1% increase based on that. I think it's because mutual funds now invest in the spiders. I think it's because high frequency trades now invest in the spiders. I think mutual funds investing in the spiders has a tremendous amount more to do with the overall volume on the spiders than individuals actually controlling the money.
Can I go all tinfoil hat on you guys?
Sure.
I already got mine. Hold on.
Yeah. Fold it up. Yeah. Put it on. I honestly think one of the major crashes that you're going to see in the next 5 years will be based on flash crashing type economics that we saw in 2010. Do you remember that day?
Yep. Did you see that fat finger trade I put in the other day? I think I posted to the blog about the fat finger trade that they caught it in advance this time. But they attribute the flash crash that we had back in 2010 to fat finger trades, and then I read an article. There was a fat finger trade placed this last week, but they caught it in advance. And again, in that article about the operators down on the New York Stock Exchange floor, there are people who moderate those things and watch them, and they can catch some of those fat finger trades. They're not going to catch them all, though.
Right here. See this day right here? Guys, I mean, basically, I was working downtown Salt Lake City, and I was working with a student at the time, and my office used to be in the Union Pacific building. It's, railroad's a big part of Utah history, and I had an office there. And I walk out the door at 12 o'clock to go get Thai food at a restaurant that's no longer there, Noah, Typhoon, which I used to like a lot.
Yes, absolutely.
But they closed her down. And when I left, the market was down 150 points.
I think we could correlate their shutting down to us moving out of that office.
I think so.
I think we were half their business, but anyway.
When I got back from lunch, the market was down 800.
I was at the airport traveling to go teach a seminar, and my phone lit up, and I didn't see it. I had looked up at the TV screen, and I saw what was going on, and I just got a ton of phone calls from people I'd worked with, students, co-traders, people like, you see what just happened? And that's one of those days you're glad you got stop losses in place.
Yeah. Well, and this is where the tinfoil hat thing comes on, Matt. I can conceive of scenarios where somebody with ulterior motives could try to crash a market just to create volatility, with these computer algorithms and whatnot.
I don't even think that's a tinfoil hat. I mean, has that been the case forever? That big dogs crash markets. I mean, that lead the crash markets. I think that the biggest difference that I see with the high-frequency traders today versus even in subprime and dot-com crashes is the fact that I think it's going to be nastier, brutish, more hawkish, and I think it's going to be a hell of a lot faster.
All right. Guys,
so what does that mean to the new trader? What does that mean to the new person out there?
Well, I'll tell you one. Matt, you go ahead, though.
Well, my honest opinion, what that means to the new trader is they need to learn how to trade immediately. They need to learn how to trade. They need to start taking control, because if they sit on their hands and do nothing, they're going to get blasted when it happens. Nobody can identify exactly when that's going to be. But once these things start breaking support levels, what do you think the high-frequency systems are going to be doing? The high-frequency systems right now are buying right now at support. That's what's keeping the market up right now, is the high-frequency trades are buying at support levels. Once that pattern is broken in the markets, every one of those high-frequency systems that are buying at support levels are now going to reverse and start shorting the market. Not sell positions. They'll start shorting the market, and that's when you're going to start seeing the crashes. And, I'm looking at the market price right now, and if you look at a weekly chart, Look at the weekly chart on the S&P 500 currently, T.
Noah, can I pass the baton to you? My friend just showed up to help me with my electrical work. I need like 2
Do I
minutes.
have control is the question.
I'm gonna stop sharing. It's what we call teamwork. Are
keyboard
you
and mouse control?
Are you the panelist or the organizer? I see 2 Matts.
Boom.
I'm the panelist, I believe.
Hang tight here.
That just.
So I'm going to be showing my screens what's going on here, right?
Yep, and just 2 shakes.
All right.
And
you need to make me a presenter in order to do that. So.
Yep, I just got to make sure I know which Matt Justice to do. I guess you're the organizer. Let me.
Wasn't able to figure out how to change my name either.
Make you a presenter. Does that work?
Matt what was our running joke? Yes. I am now a presenter. That works.
There we go.
I changed mine just to Matt.
Okay.
There you go. Let's see here real quick. So can you see my screen now?
Yeah, but let me throw in one thing real quick before we lose the train of thought on that conversation a minute ago. Another really simple thing that people have to do based on all those algo-based systems is use a stop limit, not a stop market. I know it's a simple thing, but especially in the options market, if you just put out a stop loss without using a limit to control your fill, you're just begging for the market to take your money, in my opinion.
You are.
Yeah.
Order entry, very important.
I'll be right back.
Aspect of it.
All right, the chart here on the spiders, if you don't mind.
All right, so I got the spiders. I'm a day behind apparently on my data. Hang tight here real quick. Oh, I've got somebody else logged into my software. Hold on 1 second. So I'm showing up to yesterday's data, not today's down day, but let's go ahead and pop open the S&P. Okay.
And then pull up a weekly chart.
Okay, we go weekly time frame.
Okay, draw me a trend line connecting from basically the right
bottoms all through here. Yep.
Okay. Once that support level is broken, that's when the algos are going to start dumping.
Yeah, you've got that kind of key level. And I mean, you can see the general slowdown in buying. That's what the slowing momentum is, and you know, the patterns that I've been teaching over the years are really probably what I would define as institutional trading footprints. Where whenever you see that big run followed by a smaller run, that slowdown, that's your first clue. You'll see the sizes of the drops sometimes increase. We'll watch for double tops. You know, I don't know if this is going to be if they're going to be buying off of this dip as well, if it's going to be rallying out of here. You know, they gave us that good look on it early Friday and then early in the week, and then Thursday, Friday, and then slowed down early Monday. We have a down day today. I've got to reload to make that happen.
Honestly, no, because of what's happening today, you're right at that same type of level today. And, you know, that's why I sent out a tweet earlier today. I said, this is a very, very important moment in the market. You know,
well, absolutely.
Extremely important moment in the market where we could potentially find some type of direction, whether it's up or down. If the market does not hold that trend line of support, I fully anticipate the market testing 1900 and ultimately potentially even 1800, which would be our standardized correction in the market.
Well, and then how are you coming up with those numbers, Matt? I don't disagree with you at all. I just want to know what, just for the benefit of our listener.
Is an old resistance level, and then 1800 is just your standard correction number, 10%.
So, yep, 1900, talking about old support, and they're just big fat numbers. Like you talk about, you know, if you look at where the market's finding support and resistance, and you say 1800 clear down, bring in some more history here.
And 1800 isn't technically as important. It's more just a percentage drop. It's that 10% drop in the market.
Okay, and then I always like to look at my Fibonacci's, and they'll coincide with all that fun stuff, and ballparkish. You know, the overall slowing down, I definitely see it. We've seen it before, though, and the market can take off. So slowing momentum is just the first possible warning sign. So here's an example of slowing momentum back here before the last major market correction. The slowdown right there. And then you see that the next rally it fails, and you get that.
Well, I mean, eerily similar in terms of that slowing momentum to what is happening in the marketplace right now. but you're also talking about like economically very similar as well. You're talking back then, I mean, we had the European debt crisis come out in August of that year. In June of that year, you had the Fed come out come out of quantitative easing 2. Now we're dealing with the Fed coming out of quantitative easing 3, and we're now dealing with another European recession. You know, where half of the 17 member nations in the euro are bankrupt and are going to default on loans. I mean, you're dealing literally, I mean, outside the geopolitical, Russia, Ukraine, Syria, Iraq, China protests, that stuff, you're dealing with a very similar technical and economic market as we were in 2011. And 2011 was an 18% clip in the marketplace at the time. And if you see something similar, you're talking about the market coming down into 1,600, which would be a 20% correction in the marketplace as well. That wouldn't shock anybody.
No, not at all, not at all. And again, like I say, they do happen fast. And once those signals come in, you can kind of look back at some of the previous markets. When they finally do make that decision, you'll see that the drops can be relatively quickly. You know, they cover that distance in just a short period of time, just a couple of weeks.
That 18% was a month. I mean,
yeah, so yeah, that's 4 weeks right there. Boom, boom, boom. And so you can see that same kind of move. It always starts out small, but once it becomes clear that that zone's been broken, that's when when you see those key support zones break, it becomes a pretty much an all-out bear fest.
And if you remember back then, I mean, people, they look at this marketplace and they're like, oh man, it's getting volatile. It's getting volatile. We move 1% a day. You know, right now we're I think the S&P 500 is down 24 points, so about 1% and what is that, 1.15% or something along those lines. At 1.24%, okay?
Okay, well, talk to me about this concept, Matt, here. We've talked about, we know that we have, we can call it the plunge protection team, the people who prop up the markets, the Federal Reserve, the central banks, and we can actually go back and put some little footnotes in here. When you have the markets melting down back in 2007-8, these bottoms were forced in by the Feds that was a emergency 3/4 point rate cut. Here was an emergency 1/2 point rate cut. And here was the TARP, the bailout. That's what forced this bottom in. The very first sign of getting spooked, they forced in QE2 right here, and then they came out with QE3, perpetual quantitative easing. So each time the market got spooked, you can force in those bottoms were forced in by quantitative easing, and they've, here they cut our interest rates down to nothing. Here they've done, perpetual, basically printing of money, quantitative easing, printing of money. What are they going to do on this? What kind of tools do they have?
Because you look at the typical response, and this dates back to 1936. Keynes' economic principles, 1936, was basically derived from when you have recessions. Okay, it's not basically what Keynes said was you did not have any type of supply problem. You still had manufacturing. You still had products to sell. The problem wasn't on the supply side. The problem was on the demand side. Because when consumers get scared, they stop buying. And consumers account for like 70% of the American GDP. And so from 1936 until really 1982, every time we had a recession, what the Fed would do is they would slash interest rates. And what the government would do was start to buy products and goods and go into debt. And so that's what happened from 1936 until 1982. And really this type of Keynesian economic principles and whatnot led to the economic stagnation of the 70s, the inflation of the latter part of the 1970s. And from 1982 to 2007 and 2008, basically you had a neoliberalist mentality based on both the Fed and the federal government. And what the neoliberalist principles, economic principles was that both you would basically have a very standardized approach to the Fed. When the markets went down, Fed slashes rates. When the markets go up, Fed raises rates. Okay, government would stay out of it completely. Not in no capacity, no regulations, nothing. And basically that led to the subprime market crash in 2007, 2008 when Wall Street and the big banks did what they did. So you're absolutely dead right with the response in 2008. The Fed did exactly what they were taught to do, what they have been prone to do. They slashed rates, and then they brought back the old Keynesian economic principles of let's become a buyer. Let's become, because the marketplace is spooked, let's become the buyer. And that's the Fed, for the first time the Fed did that. And now when you're looking at the marketplace today, unlike marketplaces in the past, we haven't seen the interest rates actually be raised. We haven't seen the Fed stop being the buyer. We haven't seen, and so right now we're at the top of a market, but interest rates are still very, very low at the top of the market. You still have the Fed. The Fed right now is coming out of quantitative easing at the top of the market, not at the bottom of the market. And so you're looking at a scenario where the marketplace crashes again. What does the Fed have? They fired their 6 shots. They have a 6-shooter. What do they have? They can't cut rates.
I believe that says, Bugs Bunny says, no more bullets.
Yeah. And so to me, what's going to stop the next crash? I see the next crash. I think the market cycles will pan out over time, but I do see the next crash as something that is potentially larger in scope, both from a percentage and a total dollar figure, than the one we saw in 2008.
Yeah, well, absolutely. And, this, if you look at, again, how those markets have been propped up, the actions of the plunge protection team, the way that they do those things, and that was a very, very good description of that, Matt. Thank you for that. That definitely creates some, I think it creates an interesting problem for those who follow traditional investing models, but it also creates an amazing opportunity for people who know how to trade.
Honestly, no, I think it's the biggest opportunity we've ever been faced with.
Unbelievably huge opportunity, because there are, I think everybody across, globally is going to be affected by this. I think in America, U.S. specifically, I don't think there'll be a person who's untouched by it, especially those who invest in their 401ks and their IRAs and follow that buy and hold long-term strategy. They stand to lose a lot. And so, for those who are in the right place and prepared and know how to take action, they stand to gain.
Honestly, no, this might sound rude, but I do feel bad for them, but at the same time, it's not going to stop me from taking their money.
That's what I like about you, Matt. That's one of the things I like about you most.
Responsibility. Hey, pull up a chart on the Russell 2000.
Well, I want to throw my hat back in the ring here. I've been sitting here listening, and I do enjoy the conversation. But one thing I firmly believe in is always looking at both sides of the market. We've got like 5 minutes until the market closes. The S&P is closing at the lows today. We're all concerned about bearishness or excited about bearishness, depending on, whether or not you're taking advantage of it or not. What about it possibly just snapping right back? What causes a market to drop like this, Matt, and then just have a big day like on Friday?
I'm telling you, high frequencies are hitting the lows.
Yeah,
okay? That's what's causing it. It's not investors. It's not traders. It's high frequency traders are hitting the lows, and right now they're not doing it. This thing's selling into the close. It's honestly speaking, guys, one of the first times I've seen a heavy sell into the close.
Well, look at that. The telltale sign here for that, Matt, is the shadows on the candlesticks. Mm-hmm. Shadow candlestick. You're seeing that. We got that last week, but we're seeing it continue to close down. This is the lowest close we've seen on the Russell on a weekly time frame. I mean, that's a strong signal to me. It's coming into that zone where previously there's been buyers. They're not stepping up.
Yeah, I mean the E-mini is actually at 1928 right now, guys.
E-mini S&P.
Yeah.
Yeah, no, it's breaking down. The ES is breaking down like crazy.
I got a TOS platform open. Hold on.
Oh, no, it broke down when we started the coaches show at 1940. It's 12 points down from where it broke down on the intraday. And then you also, after the bell, you've got another 15 minutes of futures trading. I mean, this is the kind of action that, is real nice if you're a day trader.
In the last 10 minutes, you've had 123,000 contracts being bought on the E-mini contract.
Mm.
Those are on puts.
Wow.
Big red bearish candles.
So here I've got chart.
Tell me what market participants is buying 123,000 S&P 500 S&P E-mini contracts. Those are algorithms.
Yeah.
Are you looking at time and sales on that, Matt? Can you see those?
Yeah.
Yeah, absolutely. So time and sales, E-mini S&P. Yeah, 225, is that?
It's currently at total, this is the grand total over the last 15 minutes of 130,000.
Yeah, like you look at some of those bigger contracts, like you can see the small traders are the ones in the twos.
Yeah,
Um,
that's us, you know.
right, yeah. And then you're going to see, when you see like that, big ticket in there for 200 some odd
44,
contracts, that's
44.
definitely, yeah,
Those are the big dogs.
absolutely. So that's kind of fun data to sit and watch. It'll drive you crazy, I think, if you do. Sit and watch time and sales data, and you can sit, get a little overwhelmed with that constant stream of information.
Well, and we're obviously selling into the close, and I want this to be very clear. This is the first time I've seen a heavy sell into the close on such big volume in a while. It's been a while that I've seen this type of action. But tomorrow we have a huge economic event. Okay, how is that economic event, the Fed minutes? How is that going to impact what the price is doing today?
Well, let's talk about that real quick here. Let's go. You're talking about Trade Center. Let's look at the calendar. You got Fed minutes. Now, this is not a policy statement, but this is just their regular minutes, right?
Yeah, it's the meeting minutes. Yeah.
Just Fed minutes.
So just the regular meeting minutes. And what do you think? We got it, 2 p.m. Eastern, so it'll come out late in the day. My expectation is you might see some people doing a little bit of wait and see, holding off to see what the Fed say.
Yeah, I think it's going to slow into the open tomorrow.
Yep. So it might slow down, and then we'll watch that. I'm not sure what they're going to say. I have no idea. I've got to kind of get my head around some of the information that's been coming out before I make an assessment.
Ooh, big. We're up to 172,000. It's 79,000 contracts. Finishes at 1927. Obviously, this is going to continue to be traded because it's a futures contract. But
yeah, that's some pretty big volume in there. You bet.
It's huge, man. Big spike.
That's pretty big. If you look at that in comparison, let's look at that over the last several days here. That's a pretty good size spike in the end, but it's not on up volume; it's on down volume.
Down volume at the end of the day too.
Mm-hmm. Well, and look at all the rest of the spikes outside of the spike on 925. The rest of the spikes have been up, moving up, moving up. So it'll be interesting to see kind of what happens tomorrow.
Yeah, that's a pretty good spike into the close there. And then if you just put that into your daily perspective, people come home, look at that, and that's going to give them a nice bear signal. That's starting to look more like a violation of that trend zone, just what you were talking about, Matt. You plop open a trend study on that, and you start to look at that violation in there. That's starting to.
Russell 2000 is at its lowest point since last October. Closed at the lowest point it's had since last October.
That's your Dow. And let's look at the Russell. Oops.
You can look at IWM for that too.
Yeah, you bet. Sorry, there we go, TF. Breaking lows. So lowest point, below, and again that's like we're talking about those candlesticks there. Kind of interesting how that works.
A little nerve-wracking, honestly speaking, but actually pretty good day in the market today.
Yeah, I like the volatility. I love it.
I just wish I had all my bullish trades just not in the portfolio today. But I had a lot better day.
Well, I've got some good bear picks for you to add into it.
Well, honestly speaking, there's been really one thing I've been doing the last 2 months. It's I'm long stocks in S&P 500 and Dow blue chips, right? And I'm short IWM. Because it's the small mid cap, so it's been working out fairly decently. I had a good day in the market today. IWM kicked tail and took names, but I had trades on Southwest and Lockheed Martin, and have trades on CME and whatnot that are kind of offsetting it.
Yep. I've got
You
a
gotta have
handful
to.
of bullish candidates out there that aren't panning out so hot. So,
Well, I mean, that's. I hope everybody understands that not every trade works out. No trading system is based on 100% success rate. It's based on controlling reward and risk ratios, probabilities, all of that jazz.
well, and managing your drawdowns. That's really the key to success is managing your risk.
Yeah, I'm lucky. I got a stop loss at 175. So.
Yep. In fact, I've got Northrop Grumman Group. I've got NOC. That's basically the same trade, Matt. You and I are in this defense sector, kind of bullish the defense. I can't imagine why.
Yeah, I mean, shockingly, right?
Yeah.
Shockingly, we'd be bullish on defense companies.
Yeah. So, but and independently, we never talked about that. That's just one of those things that you naturally start to gravitate to after you've been trading for a while. Global news becomes actionable information.
Like to drop bombs on people. Defense companies going to have to produce bombs.
Well, somebody's got to make those drones too. So but those are things that
war over there too, over there in Syria right now.
Yep, absolutely. So interesting. I like to look at let's look at the retail sector. And that's one of the things I look for this time of year, kind of heading into, because that October month seems to be kind of a make or break month for the markets oftentimes, especially heading into fourth quarter and, kind of looking at forecasts and outlooks for fourth quarter, watching what's going on with retailers. Retail holders, that's looking like triple top action right there. Had run relatively steadily up in there. Now we're seeing some volatility and possible reversals.
Honestly speaking, though, I was tracking every sector in yesterday, and not one sector in the S&P 500 is actually increasing momentum. I mean, healthcare is probably the best of the best, and even healthcare is starting to double top.
Well, one of my bear picks was the XLY, consumer non-cyclicals, and that's a bear, shadow came in today. Looking for that to drop down to the support zone. So that's the XLY. We could look at if you think healthcare is the strongest of the bunch, I'd agree with that.
It's even showing weakness, though.
Showing some weakness and slowdown.
I'll tell you right now, you're seeing a bubble burst in the bond market, and you're seeing a bubble burst in energy and basic materials. Look
at the bond market in here. This is the BND. This is the Vanguard Total Bond Index. And one of the things I talked about in the newsletter
this week. I love your write-up on your newsletter this week, by the way.
Tried to make it interesting. Pretty boring topic in general, but there's the flight to quality you see there. A little bit of rally in the bond market as money comes out of stocks.
Yeah. Look at
XLE. XLE. Down. Now that's one where I see them like that. I watch for the rally on those. But
I would not be shocked to see a correction, but I still see it being bearish.
Technically, I want to jump in and buy that. I have this irresistible urge to buy that bad boy for some reason. But I would have to do that with something like some sort of risk reversal, some sort of poor boy trade, maybe sell one put to buy a bunch of calls, or maybe do something like a back ratio. I don't want to jump into that. That's a southbound train right now, but I'm starting to imagine the volume building. Now, why does that volume build so high? That makes me want to go bullish on energy.
Yeah,
that's a key price point.
But again, I want to make this very, very clear. In terms of just my overall assessment of energy, I do see a short-term pickup in energy, but overall, I see this going down. It's one of the worst sectors right now. Look at XLB.
Oh, this will be it would be a good bear retracement after a rally. So you catch that rally, you turn around and short the heck out of that.
Exactly. XLB. This is basic materials.
XLB is your basic materials. Getting crushed. Nice break of support. Now that's a signal. You got two failures of support zones in violation of primary trend.
Yeah,
you might be down.
You're not seeing today's data on it.
No, I'm not. Did it come down hard? Yep. I got a pop open.
Yeah, pop it open and toss.
Yeah, let's pop that over there. We'll XLD. Yep, that's down today. Nice.
Big breakdown.
Big
And I see that
breakdown.
going down at least another 3-4%.
I'd say 46 target, easy.
Yeah. 46 is a
Easy
great
on
target
that.
for it. Old support, old resistance. You know, it goes down 1.5 on 47. Yeah, that's about 3%.
So that's another good bear pick. Add that to
So
the list.
good luck to all you gold miner bugs out there.
Well, that's the other thing. We watch the dollar signal. We've talked about it in the past. Have we seen any life come to the actual precious metal itself? Not the mining index, but the actual.
Yeah, the miners got smoked today, but silver actually had a really good day yesterday. If you look at silver yesterday, today's silver got beat up a little bit, but not too dramatic, I would say.
A little bit of a rally in there.
So we had a really good day yesterday. And if we anticipate the dollar going down, don't you anticipate silver and gold going up?
I would, although I'm not so sure we're not seeing any sort of fixes come in on those markets as well. Let's take a look here. Let's take a look at the spot gold. I'll tell you what's driving me nuts lately is the updates on TOS. They moved everything.
Oh, and it's slow right now. Like my charts are taking forever.
There's your rally in gold coming off that. So it's almost mirror opposite the dollar.
Mm-hmm.
Just boom, boom.
Well,
So, and I would expect those to invert. Like I do expect that.
Let me ask you guys both a question.
Okay.
If the market does tank, okay, and I hate to even say that because when I'm talking going down, I initially only target like 10 to 20%, right? You never actually go into there and thinking, okay, the market's going to crash by 70%. Yeah, it might happen, but you never actually do that. But let's say the market goes down 20%. What would you guys anticipate happening to the commodities? Would they finally find would the bulls finally find, a little bit of momentum in gold and silver?
I think you might see some flight to quality in those because people they don't know where to go. So gold and silver, I think, would be a place to put some money.
Mm-hmm.
They like that idea. Bonds, you probably see a continued spike in bonds. Cash is a position.
Even if they're getting paid nothing, they will go to bonds.
Yep.
When I look at the initial, like in 2008, gold certainly went down in 2008. Went from 100 down to lost about 30% in value but when it got to the worst, when the S&P 500 got to the worst in 2008, September, October, gold found the bottom and started its ridiculous run where it basically, it made 150% in the next 3 years from there. So I don't know. Is gold going to find their footing here? At the $1,150 level? I don't know. Maybe.
It's a key price point for it. Silver's been a little bit below its key price point, but it is a big key price point there at 1,200.
Yeah.
It'll be interesting to see how it plays out. I haven't seen a real build in volume yet, which is one of the things I look for. So no atypical volume, and I don't see any reversal signal at this point in time. So just something to keep an eye on. And if you're looking to trade those, if you're not trading the futures, probably take a stab at an ETF like GLD or SLD.
Yeah. Something
along those lines. Their memory. Look at that. Like I've got a pretty solid machine, and it just sucks up the memory, kills me.
It's slow.
They've turned it into a bit of a pig. Great for trading, but they invariably have to shut it down and reboot.
And the thing about gold, Matt, if the market does take a 20% hit, I don't think gold will necessarily rally right away. I do understand eventually a flight to quality and money moving back into gold. We talked about it on the podcast last Friday, the three of us a little bit, and I could see that eventually. But I think in the short term, if you're going to have that kind of action, I honestly think assets all kind of get hit at the same time. I think gold, commodities, and equities.
I agree. I honestly think you're going to have an opportunity to buy gold at a much stronger technical level in 3, 4, 5 months from now than you will today.
We got to wrap this one, boys.
Good coaching.
Yeah, this was fun. It's fun.
It's always a good time. Let's go ahead and see if we can get any questions in. Any questions before we wrap it up?
I haven't figured out how to find the questions. I might be the dumbest person on this.
They can type into the question, or they can ask for the mic, and we can under the question tab. You can ask for the mic.
Okay, guys, if you want us to analyze anything, look at any of your trades, or just have questions economically or whatnot, go ahead and put those out there. I thought I'd use my radio voice on that one.
Yeah, that was a good one. I think we've got. Well, I see the two Pauls are still here. Owen, Mike, Mario, and Kitna all here as well. Find that Q&A, and they may not be able to find it either, Matt, if you can't. We're still trying to figure out this software. This Citrix GoToWebinar software is pretty cool, but we're pretty new using it, so. All right.
Because the chat function doesn't, like, I see the chat function.
Yeah.
Questions is where I'm seeing the questions come in, where people have been able to type, and I've been able to see it. So
sure. I did get some questions on Twitter for our thing, and I did want to update everybody. You know that thing about cutting my hair, Matt?
Yes.
I found a good place to donate my locks, and I'm gonna take it down.
Let's hear it.
What do we call it? Locks of grunge? Wait, what do we?
I'm trying to find the email.
Shower first.
One of our members, who is a team member with us, Todd, who listens to our podcast religiously, he sent me a recommendation, and it's called Wigs for Kids. And all I've got to do, if I understand it, I got to go back and make sure I understand it, but I got to take out a form, fill it out, take it to just any local hair place, and then just cut it there. They box it up, they send it, and then they donate it. So I'll take some pictures and put them up there on Twitter or whatever. But I think I'm going to take Todd's advice and go with his Wigs for Kids.
That is awesome.
Oh, we did get a response. They don't have any questions. That's always good. So
yeah. And one thing I like about this Wigs for Kids, I was reading about it, is it's only for kids who have lost their hair because of chemo treatments or radiation. And so it's a really good cause, and I need to get a haircut anyway, so. Yeah.
Wigs for Kids. It's there you go.
I like it.
That's a fantastic cause.
Good cause. Good for Todd. Todd, shout out to you, buddy.
Yeah.
I like it.
Well, you guys have been listening to the Trading Justice podcast, also watching the Coaches Show on video. You can find everything we do as a team over at tackletrading.com. Take control of your financial future. Let's bounce around the room, get one last thought. Let's start with you, Matt.
I want to get both of your thoughts on a couple of headlines real quick, okay?
Okay.
Warren Buffett, we all know the Oracle of Omaha, says Hillary Clinton will win in 2016. Initial thoughts?
I think it's way too early politically to start calling that. And Warren Buffett probably has more clout in the financial world than the political world. But so I think it's way too early to call that.
I don't really have an opinion. I've become very apolitical. You'd have to believe that the system's not fixed.
Yeah, and there's 2 years and probably an economic calamity between now and then usually you'll see our political system move from one side to the other quite frequently. I don't think so, Matt, to be honest.
You guys are both sitting on the fence.
No,
I don't know. I don't think I've seen a viable candidate from the right side. I think the left side, she'd be tough to beat just because she'll get her the cronies out in droves. So. The right had better come up with a good candidate. I sure would like to see a good viable third party candidate come in and shake things up.
Yeah, I would love that, but that will never happen.
It will never happen. Absolutely.
No, she will not win in 2016. There's too much baggage there. Next one, GTAT, the producer of all Apple screens for iPhones, iPads. Bankrupt yesterday, $1.5 billion in market cap, completely gone, spoof, gone.
Does that mean I can get my screen fixed if it breaks?
I think so, maybe, hypothetically.
I believe, is that because of the new iPhone 6 that bends that they went bankrupt?
I do not think so, but lost 90% of value yesterday. Overreaction,
Are they public? What's the symbol? Are they publicly traded?
GTAT.
What was that one more time?
GTAT.
GTAT.
Technologies.
Let's see here. Whoa!
$11 to $1 in one day.
Bye. No. Bye.
It wasn't. It was announced during the actual trading day. Okay, it literally gapped during the trading day. It was amazing to watch.
Wow.
And yesterday I was talking to a bunch of students, and this was at 1 o'clock. Pull up the intraday data from yesterday, Noah. At 1 o'clock, I said, guys, I'm not saying this is smart, okay? I'm telling you, look at that. That's during the trading day. That's after the market opened.
Whoa, boom.
Yeah. Okay. Anyways, at about 1 o'clock.
Hold on, I gotta get that on a 1 minute time frame. I'm on 5 minutes. That doesn't do it justice.
It was actually quite spectacular to watch. It reminded me of the Seinfeld episode.
Wow, that it really truly did. Look at that. It really doesn't show it on a 1 minute time frame. It really shows trading starting at $1. You could not.
Well, they halted.
That
trading 3 times yesterday. 3 times they halted the trading because it was getting smoked. But anyway, so at 1 o'clock yesterday, I said, this might sound dumb, not very smart, but it was at $1. I said, I'm going to buy. Okay, and so I bought yesterday, and I said, I'm just going to hold through because I think they're going to get an initial uptick tomorrow. And
that's
so,
what we call the dead cat bounce, right?
Yeah, so I bought at $1, and I sold at $1.80 for a rock solid 80% return today.
Well, fantastic. I hope you use play money to do that.
I'm not doing it again.
Yes, dead cat bounce is a very bad visual. Sorry to animal lovers everywhere, but that is not the name I came up with. It's just what happens after that kind of stuff.
It's just the name we've given it. So yes, that's so GTAT bankrupt. Apple didn't get impacted yesterday very much based on that, but going to be interesting. That the company that produces all of their screens.
No, but I wouldn't have a problem taking like a bear call credit or something on Apple. That's a symmetrical triangle. Looks like it's breaking down. It's just hugging around that $100 price point, but that symmetrical triangle, that to me I think is itching for a breakdown. So
I think so too. I think Apple goes down from here.
Yeah, could be a potential bear candidate to add to the list.
You know, I was asked the other day by another student to basically it was on the web Tackle Trading. It was one of our people from over there, and he said, "Hey Matt, can you help me understand the probability of this trade?" And it was a directional trade, and I said, "Well, first of all, I wouldn't put any probability over 50-50 right now. Agree or disagree?"
Yeah, I'd say 50-50. I don't know that. I mean, I don't make any.
50.
I'll make a bold prediction for you guys. Tomorrow morning, the market's going to open at 9:30 Eastern.
Yep, and it's going to go up, and if it doesn't go up, it's going to go where?
Down or sideways.
Down, it's going to go sideways. That's the one guarantee we can give you in the market, which means Noah's bear call spread on Apple might be a really, really good trade.
What's the future? What did the futures contract do the last 15 minutes after the bell?
Let's take a look here real quick. I had to close down my TOS, so I don't have a live feed.
A little bit up.
A little bit up?
Yeah,
that's probably a good note to wrap it up on. My final thought, Tim, is just going to be I'll throw out a few more candidates, technical trade candidates today. I'll put out a new bear list, new bull list for anybody who's interested in checking those out. I'll put them on the blog.
Well, and then my last one is, guys, you know, this whole tackle trading team is something we all believe in. If you have requests for content or you want to talk to any of us, hit us up on Twitter at Tackle Trading, or you can email us team@tackletrading.com. A lot of what we want to do here is incorporate that team atmosphere. It's something we believe in because it's something that we've all used over the years as friends and colleagues and traders to get better. So that's my final thought on this one. Matt, this was a lot of fun.
Yeah, no, I had a great time.
Yeah.
I
All
have
right,
fun
guys.
wherever I go. So it's been good, been fun.
Yep.
Later, everybody.
Peace.